All right. Good afternoon, ladies and gentlemen. My name is Abdul Kareem Dewan. I am the president for Central Jersey Network Professionals. Thank you all for watching this video tonight. And I will be the host for tonight's webinar. We have as presenters Mark Seabrook and Felicia Zorin, and they are here to talk about covering your you know what. Yes, ladies and gentlemen, the A word, the assets. One of the most important things that we should watch out for nowadays, especially after graduating. You're coming into this new life. You got a new job. You're building your wealth. You're building, connections, things like that. And one of the most important things is your assets, how to best protect that and how to best, ensure that for this case, in finding the correct insurance to properly protect those assets, not only for yourself, but for generations down the line. And even if you're not, graduating, maybe you're a little further down the line, with more experience and a higher net worth. You should still, always reevaluate your position and, making sure you cover, yes, the A word, assets. So I'll give everyone a brief introduction. If you have any questions, feel free to post them in the chat box, and we'll be more than happy to answer those questions. I'll just give a brief introduction, and before that, I do that. Just some upcoming events. CJNSBE Professionals is hosting a bridge building contest for high school students. For more information about that, feel free to email info at cjnsbe.org. All right, and now to move on to our presentation, Introduction to Insurance. Mark C. Brooks is a benefits consultant with Aflac in New York, assisting individuals and small to large companies, boosting a robust benefit package at no cost to the employee and on a voluntary basis to the employees. He protects families from catastrophic events such as a major illness or injury by providing a safety net when they need it most. His goals are to educate and protect the lifestyles of his clients. He's an entrepreneur, certified project manager with over 10 years of experience, as well as a certified life coach. Mark has worked in the financial services industry for 15 years. He holds a BS in finance from St. John's University, obtained his coaching credentials from New York University, and has a Green Belt Six Sigma training from Villanova University. And also the co-host as well, Felicia Zorin. Felicia Zorin is a benefits consultant with Aflac New York, assisting small to large companies with providing a robust benefit package at no cost to the employer and on a voluntary basis to the employees. Felicia witnessed the provable benefits of Aflac on a first-hand basis after using the benefits herself at a prior company and seeing the impact Aflac made at this company. Now a benefits consultant with Aflac, she helps both small and large businesses attract and retain quality employees with potential tax savings for implementing the programs. Additionally, she sits with individuals and families to help provide similar programs with a cash safety net when they need it most. Prior to coming to Aflac, Felicia spent several years underwriting loans for Fortune 500 lenders in the auto, home, and fine jewelry arena, and relatively the same number of years as a writer, editor, and proofreader for an international publishing organization. Ladies and gentlemen, Mark Seabrook and Felicia Zorin. Thank you.
Good evening, and thank you, Abdul. And I want to thank Nesby for inviting us to provide some information to you. And first of all, I want to kind of piggyback off what you said about assets, because at the end of the day, it's important to protect your assets. I know we use that phrase thrown around in various ways, but at the end of the day, It's important that we have our ducks in order, no pun intended. And it's really important that we plan ahead and be strategic about not only our lifestyles as individuals, more importantly, as we're moving through life, that we protect our families. So, our job, on a day to day basis, Felicia and I, is to educate people, not only what we're doing, but more importantly, just be able to help people on making decisions that's going to be best for them. And, let's be realistic. Sometimes that might not necessarily be us, but it's our job to help people out, and that's what we do. So before I get started, once again, I want to thank Abdul and the organization for giving us this opportunity, and I just want Felicia to say hi before I get into my part.
Yes, hello, my name is Felicia, and thank you for giving us this opportunity to present to you today.
So this evening we're going to cover a few things. What is insurance? The benefits of insurance, types of insurance, protecting your lifestyle, statistics. Are we investing in insurance? And when we use the term we're referring to our demographic, people of color. That's who we're referring to. So let me go right now into what is insurance. So a practice or arrangement by which a company or a government agency provides a guaranteed of compensation for specified loss, damage, illness, or death in return for payment of a premium. So, based on the definition, you can see how insurance can protect your lifestyle. With insurance, like as I mentioned before, an individual's loss, damage, illness can be astronomical. As for death, your survivors will need to maintain the lifestyle that you have provided for them, or at least to cover your assets. So what I want to do now is look a little bit more about the benefits of insurance. So at the end of the day, insurance should provide peace of mind and transfer of risks. So let me ask you a question. How much money would you pay to have a peace of mind? Take a few seconds to think about that question. Insurance can provide that peace of mind. I'm sure a peace of mind is different for everyone. Just imagine an individual's in a car accident, the car is totaled, and the passenger is injured and requires medical attention. And the example that I've just mentioned, by having insurance, the transfer of risk, meaning you as the individual who had the car, is transferred to the insurance company, which can lead to peace of mind. And my earlier question was, how much money would you pay to have a peace of mind? So look, imagine this. Imagine you having to come out of your pocket, and that could be borrowing, savings, your paycheck, or some form of investment to get your car fixed and cover the passenger's expenses. So if they need medical attention, you would have to pay out of your pocket as well. You can see how the costs can add up, stress, worrying, and whatever else become burdensome for you, and not just for you, but the people as well. And I'm sure there are plenty of people, maybe not some of the people that are listening, but you might know of some people who were sued by their best friends. They were riding in the car. They were driving with them. And as a result, the person sued them. And it was stressful. It was burdensome, as I mentioned before. But having insurance allows you to shift some of that risk. And hopefully, if you were covered correctly, you're not coming out of your pocket with a lot of money. So like I said, peace of mind. So types of insurance. So this is just a list of things that, based on the demographic that we were kind of told about, things that most people will have to probably deal about. These are the things that we decided to discuss: business, homeowner, annuities, health, and life. So what I'm going to do now is take a closer look at each one of these. So types of insurance, business. So what we're saying here is we're protecting against operational losses by a business. So you just started your business and you're excited to share your mission, your products, and your services. Boom. All of a sudden, you're faced with a lawsuit or a catastrophic event, and it can destroy your business before you even have a chance to get off the ground. So you need to be protected. So having business insurance is going to help you not have to come out of your pocket. So at the end of the day, and Abdul kind of set the tone. We here at Aflac, we're always talking about protecting your lifestyle. But Abdul is right. It's all about protecting your assets. So in this particular case, the insurance is allowing you not having to come out of your pocket for anything that's related to any business issue. And that's what we're doing here. So what I want to do now is take a look a little bit closer at 7 business insurances that you should consider having if you're going to have a business. So these 7 types are professional liability insurance, property insurance, workman's compensation, home-based, product liability, vehicle, and business interruption. So I'm not going to go into great detail because a lot of you probably already have vehicles or know someone who has a vehicle. And in short, having insurance for your vehicle is just literally protecting yourself from damages, collision, being able to offset certain costs. Or as I mentioned before in the previous examples, if you have a passenger that's in the car and he or she is looking to sue you. So as I mentioned before, the entrepreneur, they're starting their business, everything is going well, and then maybe you're faced with some kind of an event. And these are some of the insurances that you should look at. So professional liability insurance, also known as errors and omissions, is basically covering the business against negligence claims due to harm that result from mistakes or failure to perform. So myself and Felicia, we have E&O's insurance. And really what that is doing is covering us if someone was to say that we misrepresented what we told them. So if I'm speaking to Abdul and I said XYZ, but he heard ABC, and now he wants to come after me, this insurance in place is protecting me so that I'm covered. And then more importantly, not having to tap into my personal money. So I'm covering my assets on my business side. So that's the purpose of having business insurance. So it's not touching my personal assets. And then going on to property insurance, whether a business owns or leases space, property insurance is a must. Insurance covers equipment, signage, inventory, furniture, whether that's theft, fire, things of that nature. Flood insurance, earthquakes, and things of that nature. Workman's comp insurance is when is added to the insurance business policy, but it covers medical treatments, disability, and death benefits. So normally an organization will have workman's comp so that when the worker is hurt on the job, they're covered. And this covers the individual who's working there. And believe it or not, a lot of the workman's comp is pretty much required for a lot of people who have businesses. If it's 1 or 2 people, that's different. But if you're working with a large organization, workman's comp is pretty standard. So home-based insurance. So we are living in a time now where more and more people are finding different ways of working. The 9-to-5 job is just maybe either not an option, or maybe people are looking to just find additional income. And so, believe it or not, if you have your homeowner policy, it's only going to cover a certain percentage if there's a business problem. So if you get home-based insurance, it could be in addition to your homeowner policy, but what it will do is increase the amount of money that you can receive back as a result of having home-based insurance. So say, for instance, if your homeowner policy, they know that you have, you've determined a certain square footage in your house is going to be used for your business. Well, your homeowner policy, it might be restricted to a certain amount of money, or it might not be covered at all. But by you having the home-based insurance, you have the ability to increase your insurance coverage. And that's what that is in general. Product liability is really just insurance that's helping you for when you're delivering your product. I'm sure you guys have heard over the years, I guess a perfect example would be something along the lines when you think about the phones. They're exploding and things of that nature. They've had prior liability insurance to cover them, to offset some of those costs that I said before. I already mentioned vehicle. And then, of course, there's business interruption. So Felicia and I, we're in business. We own ABC Company. And God forbid something happens to us, loss of income. And so Felicia's a valuable employee as part of my business. So I will probably take out insurance for her. She's a key person. And I want to have loss of income. So the business interruption insurance deals with things of that nature, helping you cover helping deal with income loss, so that you're covered. And that's pretty much, some of the different types of things as a business owner or looking to be a business owner that you should consider having. So homeowner insurance. As I mentioned before, homeowner insurance is not much different from the business. Obviously, this is focused more on the home. It's an insurance policy that combines various personal insurance protection, which can include losses occurring to one's homes, its content, loss of use, or loss of other personal possessions of the homeowner, as well as liability insurance for the accidents that may happen at the home or at the hands of the homeowner within a policy territory. So really what it's saying is protecting your assets on your property, around your property, inside your property. So the individual who was walking in your yard, for whatever reason you forgot to shovel the snow, they trip and they fall, this will fall under your homeowner policy. Okay. So what I'm going to do now is take a look at some types of homeowner policies. So we have HO1 and HO2, HO3, HO5, HO4, and HO6. So what does that really mean? The most popular, which is HO3, and then HO4 and HO6 are non-traditional homeowner policies. And they're usually for renting, condominiums, co-ops. That's what HO4 and HO5 is. And then when you think about HO1, HO2, and HO5, it's really kind of based on the level of coverage that you need to get, based on the type of damage. So, if you're living in a place where, like I said, it's flooding, then it's going to obviously be a little bit more than some place where you're living on a hill or something along that line. So, as I mentioned before, HO1, HO2 coverage do not insure the policy owner's personal belongings, only protects against damage specifically listed on the policy. HO3 covers all types of damaging. HO5, similar to HO3, but extends full protection to all personal belongings. And then HO4 and HO6 only covers belongings and only for the types of damage specifically listed in the policy. So normally when you're speaking to your person that's going to provide this insurance, he or she is going to ask you a series of questions, kind of finding out what you're thinking, and then based on what you're saying to them, they're going to recommend the best thing based on obviously where you live, the topography, and things of that nature. Okay. Next, I want to talk about healthcare. So health insurance is a way to pay for healthcare. It protects you from paying the full cost of medical services when you're injured or sick. So, in 2017, this is a really hot topic. Health insurance is covered on the news every single day. We're having conversations amongst our peers, our friends, and our family. But regardless of your political beliefs, most people understand the needs for having health insurance. So I'm going to talk about some of the types of health insurance. In this example, we have 5 types: HMOs, PPOs, EPOs, POS, HD, HPs. And these are probably pretty familiar with you guys who are working. If you're not, you probably heard some family or friends talking about them. And normally when you're starting your job, they give you a period of time to review everything, and then based on your existing doctors or based on what you're currently dealing with from a health perspective and based on your pocket, you select what's appropriate for you. So just like the car insurance or homeowner insurance, you choose a plan and agree to pay a certain rate or premium each month. In return, your health insurer agrees to pay a portion of your covered medical costs. Payments by your health insurance are typically based on discounts they negotiate with doctors and hospitals. So at the end of the day, you go to your doctor or whomever, you provide your card, and then at that point, based on the coverage that you have, and as I mentioned before, based on discounts and things like that behind the scenes, you will either be paying, 80% up front, 20%. You have your co-pays, your deductibles. If you're lucky enough to have a really great good job, maybe like working for the government, they pay 100%. So exclusive providers, EPOs, just a managed care plan where services are covered only if you use doctors, specialists, or hospitals in the plan's network. And then HMOs, health maintenance organizations, this usually limits coverage to care from doctors who work for or contracted with the HMO. So what that really just means is that the doctors, along with their contractors, to work together, and they've already kind of came up with rates and things of that nature. Point of service, a type of plan where you pay less if you use doctors, hospitals, and other healthcare providers that belong to the plan's network. Requires you to get a referral from your primary care doctor in order to see a specialist. And then a PPO is where you pay less if you use providers in the plan's network. You can also use your doctors, hospitals, and you can provide and providers outside of the network with a referral for additional costs. So a lot of these plans here, it's really just kind of just figuring out what's best for you. Um, it's very easy if you don't really have any doctors that you frequent. If you've already had doctors from when you were younger, or you want to follow the doctors that you had from your parents, then you're really kind of looking to make sure that the doctor that you have works with these particular ones that I'm mentioning in the presentation. And then everything just runs smoothly. You're happy because you're dealing with a doctor that you've always been using. They're happy because you have coverage that coincides with what they offer, and everybody's happy. And then the last thing is high deductible health plans, HDHPs. And so now you have situations where, people just have plans that are just, the deductibles are just so high. And sometimes they're linked to health savings accounts. So when you're at your job, you can kind of pay a certain amount of money come out of your check because you expect that you're going to spend a certain amount of money at a given time. So maybe you have your deductibles a little bit higher. And so some of this stuff can kind of help you from a tax perspective when you're filing for your taxes. But at the end of the day, these are all just various options that one can use. And to not really complicate it, like I said, to make things easy, it's really based on your doctor, what's going on with you medically, and your pocket. And if all that lines up pretty well, you just pick which one of these fall under here, and then it works out pretty well. All right, so now I'm going to talk about annuity. An annuity is a type of investment in which you contract to put in payments for a certain amount of time or pay one large amount of money. In return, you will receive payments at regular intervals, sometimes later down the road. Usually these annuities are obtained through insurance companies. So this is kind of also an investment thing, but normally it's obtained through insurance companies, which is one of the reasons why it's here. So this is something that you can also look to, as I mentioned before, as a form of investing, saving money for later down the road. It allows you to, pulling them out early, pulling the money out early. You will receive penalties and stuff like that. So both annuities and life insurance should be considered in long-term planning. And there are two types of annuities: fixed and variable. So it pretty much sounds pretty much like what it is. The fixed one is guaranteed, set dollar amount, set percentage of the assets in the annuity. They pay at a lower rate since they're considered relatively safe. And then the variable, on the other hand, offers a possibility of higher returns because things can fluctuate. But then you worry about your principal not being guaranteed. And then, of course, you can get a hybrid, which uses elements of fixed and variable. So some of the annuity is guaranteed that you can draw a certain percentage of your initial account value while you're alive, while at the same time offering the potential for growth with a variable rate of return. So really what it really is like, you have your you have your accounts, like sub accounts, which can usually have stocks and bonds. And so that's going to be fluctuating. And then you have the opportunity, you have the ability to get higher return. So the fix is guaranteed. So maybe you say, for instance, it's 5%, 5%. That's going to be your rate. You can never get more or less because that's what it is. It's fixed. But the variable, you have the ability to potentially get more money. And that's what that is in a nutshell. Okay. So life. A life insurance policy is a contract with an insurance company. In exchange for premiums, the insurance company provides a lump sum payment known as a death benefit to beneficiaries upon the insured's death. So I'm going to go into this one a little bit more under protecting your lifestyles, but that's what life insurance is. So now, let me just kind of recap. So we came in and we talked about what is insurance, what's the benefit of having it, peace of mind, transferring risks. Then we start talking about different types of insurance. And of course, there's other ones, variations of other ones. But the ones that I said we mentioned before are probably the things that most people, specifically if you're coming out of college and you're going to be looking to get. These are things that are going to be knocking on your door. And if you're an individual who's just entrepreneur driven, you want to be your own boss, you don't want to do 9 to 5, you're like, I'm not going to work for anybody, then, obviously the business, the home-based business interruption, all that kind of stuff like that would be more beneficial to you, things that you need to at least start processing in your mind, thinking how you're going to navigate. So protecting your lifestyle, life insurance, accident, specified health, disability, specified disease. So I'm going to discuss the life insurance, and then Felicia will discuss the remaining items on the list. So when you think about protecting your lifestyle, this goes back to what Abdul was saying earlier, your assets. So you want to protect your assets. And assets, for some people, really thinks about money. But assets is obviously your children. Assets for some people could be your legacy. Assets could be something that's physical buildings and things of that nature. Or it could just literally just be you as the individual, your health. That's an asset. So let's be realistic here. If you're the bread owner and you are not able to do your job, you're not able to provide the income to take care of your family, the family suffers. So please remember and take value and understand that you're the asset. So, Abdul, have we received any questions as to this point?
So far, there are no questions in the chat room.
Okay. So, I'm going to discuss life insurance. So there's two types of major insurance, term and whole. And so as I mentioned before, life insurance is a policy contract with an insurance company in exchange for premium payments. The insurance company provides a lump sum known as a death benefit that the beneficiaries receive the money. So term insurance. So there's two types of term insurance. And really what that means is that there's a level term and decreased term. And level term means that the death benefits stay the same throughout the duration of the policy. Decreasing terms means the death benefits drop usually in 1 year increments over the course of the policy's term. So sometimes there are a lot of people who will buy term insurance. If, say, for instance, they buy a house. So they have their life insurance, they're in the process of buying a home or maybe something along that line. And so what they're doing is they're buying this insurance to cover maybe the span of, in this instance, the house. So say, for instance, I got a 20-year mortgage, I get a 20-year term life policy. And so God forbid something happens to me, all other money that I have, meaning other insurance that I have, like life insurance, any other assets that I have, savings, investments, things of that nature will not be touched because this particular policy can be used to pay off the mortgage. And that's really what a lot of times what people are using term for. On the other hand, when you think of a whole life policy, it's permanent insurance. It pays a death benefit whenever you die. Even if you live to 100, it pays out. So you probably see it on TV where there's something on TV, it's a topping news, somebody's 115 years old, some 108 years old. And believe it or not, when you turn 100, they're giving you your money back. So it's kind of a cool thing. So anyway, I'm sorry. So the 1970s and the 1980s, life insurance companies introduced two variations on the traditional whole life product: universal life and variable life insurance, and then of course variable universal life. So universal or adjustable life is a type of policy that offers you more flexibility than whole life insurance. You're able to increase your death benefits. It has a saving vehicle, cash value account, which you can earn money based on the market. And then the money accumulates in your account, and you have options of altering your premium payments and things of that nature. The variable life combines death protection with the savings accounts that you can invest in stocks, bond, and the money market mutual funds. And the value of the policy may grow more quickly, but you also have more risk if your investment does not perform well. So, and then of course, the variable life, universal life, is a combination of the two. And so as time went on, you know, the market and individuals found opportunities for people to just use instruments, financial instruments, excuse me, that you can use to generate more income, meaning you as the holder of the policy. So in this particular case, the universal life and variable life gives you those opportunities as opposed to just a straight hold where you're just literally just paying your premium monthly and that's pretty much it. So at this particular point, I'm going to turn it over to Felicia and she's going to continue the rest of the presentation. Thank you.
Yes, thank you. So I'm going to discuss other ways to protect your lifestyle through various insurance instruments. And one of the most popular ones that people love to rely on is disability insurance. Basically, what disability is, it's a source of income replacement so you can take care of your bills while you take care of yourself after a serious accident or injury. So you can focus on getting better instead of worrying about paying the bills. And basically, as we all know, being out of work for maybe 2 or 3 months can put you behind for a whole year. And many people in the United States are living paycheck to paycheck. So disability is going to be a very important source of income if you ever need it. And interesting to see is that there was a Harvard study that showed that most bankruptcies now are due to medical bills. And of those people, the majority of them that filed for bankruptcy, they actually had major medical. So, the financial implications of, being ill has actually surpassed credit cards when it comes to bankruptcy. It's just kind of something to think about. Most people, they feel like when they have major medical, they're protected, they're safe. A lot of times people may not think about the indirect costs of a major illness. So it would be things like co-pays and special diets or lost time from work, and not just lost time from your own job, but say if you have to, you have to take care of someone else in your family, that's also lost time from work too. So that's why insurance products like disability are a great help to families, and often disability Disability is often an underestimated issue. The Council for Disability Awareness, they did a survey, and many employees thought that their odds of becoming disabled for at least 1 month are only 1%. And in reality, more than 25% of today's 20-year-olds will become disabled before they retire. So that's 1 in 4 young people. And what disability does is it pays you a portion of your income for a short period of time after you leave, or if you run out of sick leave. And so basically what disability policies do is that they will cover up to, on short-term basis, 38 to 55% of your income. Is just to encourage people to get back to work. It's not going to cover 100% of your income, but it's there if you need it. And it can also be like a great complement to workers' compensation. So say if you make $5,500 per month, you would, with most companies, be eligible for about $3,000 in private disability coverage. And as you know, in states like such one state of New York, a lot of disability payments, they're only going to be about $200 per week with the state. So that's why it's great to go into the private sector and offer yourself additional protection that the government is not going to offer you. And depending on the disability plan, disability coverage can cover you for up to 2 years or more. There is short-term disability, which will cover you from 3 months up to 2 years. Then there's also long-term disability, which is basically for someone who becomes disabled up until the time that they are able to collect Social Security. So long-term disability coverage will last until you're about 65 years old. And the average group long-term disability claim will last about 2.6 years. So that's why a lot of people opt for the short-term disability coverage, because that's kind of the average. And with disability coverage, you would pick your term in advance. You would either pick, a 3-month policy, a 6-month policy, 12-month policy, 24-month policy, or long-term, which will be up until you're about 65. And if you kind of ask people, what they think would be the main reason why they would become disabled, a lot of people kind of have in their head, a major car accident, something like that. So that's kind of what most people think. And the Council for Disability Awareness, they've done studies, and a lot of people think that a serious accident came in at 71% of how they think they'll become disabled. A stroke was 45%. People thought that would be the main reason that would happen to them if they ever became disabled. Cancer came in at 43%. Heart disease came in at 40%. And paralysis came in at 32%. And becoming injured at work came in at 32%. When in reality, for a given year, the top 5 causes of disability claims were actually different than what people expected. The main one was muscle and bone disorders, as opposed to thinking, oh, it's going to be a serious car accident. If you kind of think of it, a lot of people are out of work for a bad back or an injured wrist or an injured leg. So when you kind of think about it, that's actually true. So what you think may take you out of work, it might actually be something completely different. And a lot of people, cancer is a concern. About 43% of people thought that would be one of the reasons why they would be out of work if they were ever disabled. But actually, the disability claims related to cancer were 14.6% for a given year. And accidents were 10.6% when actually people thought it would be 71%. So it just kind of gives you a perspective that you never know what could be something that could keep you out of work. And disability, it can fill in the gaps where workers' compensation leaves out. It can provide off-the-job benefits. If you get disability in the private sector, it can offer you 24-hour coverage. And this is a win-win situation for everyone. It benefits the employee because they have off-the-job coverage, and it also will benefit your employer as well because it cuts down on their workers' compensation claims. Basically, some companies will bring in private disability because they found that in some cases people were getting injured on the weekends. Maybe a Saturday, they come in and work on Monday, pretend they got injured on the job and foul through their job. Whereas if they offered private disability that offers 24-hour coverage, it cuts down on, false claims for the company. So a lot of employers do appreciate when we bring private disability into a company. And you don't have to be completely disabled to be able to collect disability. There's always partial disability if you have a loss of income because you're not able to do your entire job. You want to think of the construction worker who's making, a lot of money working, and all of a sudden he's injured and all he can do is he can wave the flag on the side of the road. Well, that construction worker would still be eligible for partial disability so that you're not, so that it can kind of make up for what you are missing because you have reduced job capabilities. And so basically, when you think of disability, it's something that can happen to anyone at any time. Approximately every 7 seconds, a working age American suffers a disabling injury or illness that would last for at least 1 month. And like I said before, even a couple months could, put you behind for a whole year. And despite those statistics, only 1 in 3 Americans have private income protection. So you want to think, are you among the ones that have private income protection? And there are also other things that can affect your lifestyle, becoming disabled, things that you can do on your own outside of your job that can reduce your chances of ever becoming disabled. Some factors that a worker will experience a disability of at least 3 months during his or her career. And these percentages are based on the odds for an average 35-year-old. Basically, if you are an average weight, and if you are a non-smoker, and if you have just maybe a regular type job, office with some mere physical labor work, if you have an average lifestyle and, a good health history, this can decrease your chances of becoming disabled just from regular, sickness or illness, regardless of an accident. And some things that can increase your chance for a disability are, being overweight and being a smoker, or if you have a heavy physical labor job, any type of job that's dangerous is going to increase your chance of disability. If you lead an unhealthy lifestyle, or if you have a poor health history, that can also contribute to, just regular sickness and disability. And like I said, prior to this, I was also in the nutrition industry. And basically, a lot of things that are going on in the United States, about 85% of diseases are based on what you do and are man-made and how you live your lifestyle. So a lot of the illnesses are rarely inherited. It's basically, how you live your life and the choices you make. So just a good idea to make a conscious effort to make sure that, you're living your life, in a healthy lifestyle. And what I want to discuss next is accident insurance. And this is something that's being, it's being made popular in a lot of companies now. And basically just giving the statistics, I'm sure most, if not all of us have been to, a hospital before, an emergency room for maybe some type of accident, or maybe to a doctor or an urgent care. And basically, according to the National Safety Council, accidents happen to all kinds of people every day. In a given year, 34.3 million people, that's about 1 in 3 in the United States, they sought treatment for an accident. And basically, you have to think about how could this affect you. I know a lot of us worry, like, what if we were out of work? What if we couldn't work? If we have a physical labor job, even more important. And, even if you're a secretary, it could be something, an injury to, your hands, you have to type. It could be anything simple that could keep you out of work. And basically, it's what will the impact of an injury mean to your security? Are you prepared for medical debts in addition to everyday household expenditures and lost wages? You have a babysitter to pay, and you have bills to pay, car insurance. They're just all going to be a factor in that in your survival. And accident insurance helps you handle the medical and out-of-pocket costs that add up after an injury. And one good thing that accident insurance does with most companies, it will pay for follow-up treatments. And a lot of Americans, they were skipping their follow-up treatments because they have to pay a copay. You go to a doctor and you have to go once a week or twice a week, and the copay is $25 a week or $50 a week, or in some plans, $60. So some people were skipping their follow-up treatments, and that's why accident insurance will cover that, and it will help you to be able to take care of that. And according to the Disability Awareness Council, more than half of employees could not pay their bills for more than a year without an income. And I know most of us is going to be, more than just, 2 or 3 months. So if not 1 month. And some of the things that accidents insurance does, accident is it's a cash identity product. It pays the doctors and the nurses instead of paying, it pays you instead of the doctors and the nurses. Sorry about that. And so it's cash in your pocket to take care of, any expenditures you may have. And it covers pretty much everything that you would encounter in an accident. It will cover emergency treatment, hospital stays and medical exams, other expenses you may face, such as transportation and lodging needs. And some accident policies, they have a death and dismemberment feature, and some of them have life insurance built in with the policy if it's related to an accident. And the good thing about most accident policies with most companies is that there is no limit on the number of claims. There are no network restrictions. You can see, any doctor or nurse that you like or hospital as long as they're licensed. And there are no deductibles and no co-payments. And the good thing about most accident policies are guaranteed renewable, which means that they cannot drop you no matter how many claims that you file. You see with flood insurance companies, people get dropped with their homeowners, their flood insurance all the time, or maybe a car insurance if they file too many claims or get in too many accidents. This is something that you can keep, no matter how many claims you file. And they only drop you if you decide to cancel or if you decide to stop paying your premiums. And just an interesting fact of based on what's going on, you hear it in the news all the time. The greatest unintentional death, according to the National Safety Council in 2015, is unintentional poisoning deaths in the adult population. It wasn't really prevalent in the 1990s, but since then, this category has skyrocketed to first place, which is driven by unintentional drug overdose, predominantly from prescription painkillers. So if someone were to unfortunately pass because of that, then they would have, accidental death insurance built into their policy. So that's just kind of something to consider, the changes in society. And like I said before, you're either going to be out of work because of accident or illness. So another type of insurance that a lot of companies offer, especially people in the supplemental insurance industry, is specified health. And what it does is it covers the major illnesses as specified by each individual insurance carrier. So, for example, if you could pay up to $10,000 for major diseases that occur in the United States, such as end-stage renal failure, often due to kidney failure from diabetes, heart attack, stroke, and sudden cardiac arrest. It also pays for reoccurring illnesses. So even if you have another heart attack or something like that, or it will still pay, maybe a little bit less, it will still pay, even if you have a reoccurring illness, as long as there's a certain amount of days in between it. For a lot of people, it's insurance carriers, it may be, about 180 days in between. And they also, it's not just about, paying money when you're ill. The plans also reward you for staying well. So if you go for, couple years without any illnesses, your plans will build in value. A lot of times they will build in value by $500 every year. So there's an incentive to stay well and go see your doctor. We all win when everyone stays well and the claims are low and things like that. And so just some statistics that would, show the value of having a specified health insurance plan is that every 34 seconds, someone has a heart attack, and every 40 seconds, someone in the United States has a stroke. So this kind of gives you perspective on how value a specified health insurance plan could be. And another type of plan is kind of similar to specified disease. It covers one basic illness that the insurance carrier has chosen to cover. And the main one is cancer insurance. And what it does is it deals with a main issue in our society. The statistics show that 1 in 2 men and slightly more than 1 in 3 women will get cancer in their lifetime in the United States. So something to consider as being a valuable part of not letting, a cancer diagnosis ruin you. There is an article in a couple of newspapers. I know one was Newsday Long Island. A woman was featured of how, she beat cancer, but she did not beat the medical bills. And, you lose your home, you could lose your home, things like that, or your car if you're trying to cover your bills or you're going through this. And that's where, companies like ours come in place to prevent these type of situations from occurring. And basically how a typical cancer policy would work is that would pay benefits for initial diagnosis and all the common follow-up treatments that one would have, visits, second opinions, lodging, travel, surgical benefits, and extended care facilities and hospital stays. And we're talking about in the thousands and thousands of dollars. The initial diagnosis benefit with some companies can be, well over $5,000-$6,000, and follow-up treatment could be between $900 per week. So a lot of times these plans can pay out to upwards of $40,000 over the course of the treatment. So this is going to really, set you up to be cared for financially while you're going through a hard time. And there's a question of, what is a good cancer plan and how should I pick my plan? And the one thing we always say is a good plan should be based on treatment. There are some companies that offer a lump sum amount, but because you never know how long treatment will last, you may run out of money. That's why we always suggest to get it based on treatment. For example, a cancer plan may have unlimited chemotherapy, transportation, and surgery benefits, and this will benefit you. And the difference is because if you have a lump sum plan, it may pay out something along the nature of $15,000, $20,000, which sounds like a lot of money. But if your cancer treatment is, not that long, then you would benefit from that. But if you're someone whose cancer treatment is drawn out for, a very long time, that $20,000, you may run out of that easily. If it's based on treatment, you could have a payout that goes upwards of $40,000, $50,000, etc. So that's why you want to kind of get the one that's based on treatment. And basically that covers, all the basic insurance products we wanted to go over. And we kind of wanted to discuss, the African American, Caribbean, and African diaspora in the United States. And, how do we compare to other demographics? And, how are we participating in the insurance market? And based on, what we do is we go through companies and their employers. And often what we do is we're offering people, the benefits through their job. And there's just a couple of facts out there I just wanted to run by you. There is the Henry J. Kaiser Family Foundation. They do a lot of research and analysis on how, the healthcare market affects different groups and demographics and all types of people and, based on maybe income or ethnicity, things like that. And what they found was the last research done in 2011 on this one was that the number of people covered under their employer or private insurance, not government insurance or anything like that in the United States, was for Caucasian 71%, Asian 67%, Hispanic 39%, Black 47%, and American Indian 40%. So we are, we're right in the middle at 47% for being covered by our employers. And from the Center for Disease Control, the percentage of adults aged 18 to 64 who were uninsured at the time of interview, this is from between 2014 to 2013. This kind of shows how the Affordable Care Act has affected the people of color. Basically, the uninsured amount decreased, which is great. So for the Hispanic market, their uninsured rate went from 41.1% to 34.1%. So now they have a lot less who are uninsured. And among non-Hispanic white, their uninsured rate dropped from 14.5% to 11.5%. And for non-Hispanic Black, which would be our African American, Caribbean, and African diaspora, our uninsured rate dropped from 24.7 to 17.6%. and non-Hispanic Asian, their uninsured rate dropped from 16.1 to 12.1%. So what you're seeing is that between 2013 and 2014, we saw Asians have a 4% drop, and non-Hispanic whites have a 3% drop in in uninsured people, which is great. But our number of uninsured dropped the most, with Hispanic being 7% and non-Hispanic blacks being 7.1%. So we experienced the greatest increase in uninsured. So we're getting way more people insured than before, which is great. And basically, another just a statistic for everyone in general is that the Kaiser Foundation found that of people who are insured, about half of them get it through their employers. This is all across all 50 states, fluctuates between 48% and about 53%. So it's really great benefit to try and get any benefits you can through your employer. You're going to get the benefits of a group rate. It allows people who are, 65 years old to get the same rate as someone who's possibly 23 years old. So that's kind of what we do at our company and why we're proud of what we do. So I'm going to turn it over back to Mark Seabrooks to close it out, and any questions you may have.
Yeah, so I just want to kind of summarize we talked about protecting your lifestyle. And I really wanted to just circle this back up to what Abdul was saying in the beginning about protecting your assets. At the end of the day, that's what we have to do. As people of color, we need to stay focused we need to have access to the information. Once we have access to that information, use that information so it's going to help enhance and better our lifestyles. So the theme of what we're discussing today is insurance, protecting your assets. So that goes from your life insurance, from accidents, from protecting your home, protecting your business, to protecting you as an individual, protecting your family. Whether that means life insurance, accident insurance, disability insurance, which is protecting your income. Or if you're going to get down to some of the major diseases that are affecting our demographic, and cancer, prostate cancer, believe it or not, the numbers are even going higher for skin cancer, heart attack, high cholesterol, diabetes. So at the end of the day, we need to be smarter. We need to seek information, find out information, and use that information to enhance our lifestyles so that things can be better for us as a people. And so with that being said, I hope some of the information that we provided to you was helpful. I hope that it gets you thinking. I hope that it'll allow you to have some dialogue amongst yourselves. And our information is here. You can always reach out to us pertaining to anything. We will be more than happy to help you out. And once again, I want to thank Abdul and Esba for the Black engineers for allowing us to speak to you guys tonight and share this information. And I want to turn it back over to Abdul. Thank you once again.
All right, thank you, Mark and Felicia, for that presentation. Definitely, it was a lot of helpful and well presented information on insurance. Actually, I have a question in regards to life insurance. In the case of the policyholder passing away and the beneficiary receiving the payments, what are some of the issues you've seen in regards to the beneficiary receiving the payments in regards to any road bumps or anything like that may affect the beneficiary from receiving those payments?
And Felicia can speak to this. I personally haven't seen anything. I do know from a personal perspective, when my dad died, it was really just as simple as providing the insurance company with a policy number, providing with a death certificate. They do their stuff on the back end, and then they pretty much issue you a check. So at the end of the day, as long as everything is in order, at the end of the day, you just need the birth certificate stating that he or she died for whatever causes. As long as those causes are not anything that's going to negate your policy, meaning like, the person committed suicide like a month after an insurance policy being issued, then that would be more of a problem. But other than that, as long as you have the insurance policy number and you have the death certificate, there shouldn't be any problem releasing the funds.
And also, I wanted to add to what Mark said about, just if anything odd comes up. I know with some, like he said, with suicide, I know with some companies, there's a clause where, if you commit suicide within the first 2 years, they won't pay the policy. That's one of the things that they have. But on a general note of your question, one of the problems is a lot of people want to leave their life insurance beneficiaries to their children. If they're under 18, that can be a problem if you don't have a will that specifies who will take care of the children. You always want to leave the beneficiary to someone who's over the age of 18 or over if you can help it. I guess if you can't help it, then you have to leave it to your children. Just kind of think of leaving it to an adult as opposed to a child who may not turn 18 for quite a while. Another thing is you want to make sure you have a beneficiary and a contingent beneficiary. I mean, you never know. You could be in a car accident and a husband and wife pass on the same day. They're each other's beneficiary, but who's going to get it if they both, go on the same day, unfortunately. So you might want to have a couple of beneficiaries is what we kind of do. You can give them levels. This is my first choice. This is my second choice. Beneficiary versus contingent beneficiary. And like he said, and also you want to notify the people who are your beneficiaries that they are a beneficiary. They could be walking around with an insurance policy that's given to them, not even knowing that they have it. So you want to notify the people that, if I pass, I have something for you. I think there is a way to search, some type of database, but it just makes it easier. I had a friend whose mother, she left him a letter when she passed. I said, what if he had not found that letter? Some people just don't want to talk about it or don't want anyone to know that they have a policy. So it's kind of a touchy topic, but those are some things to consider when the risk of, making sure your beneficiary gets the money.
Okay, thank you. And now we have a question here in the room. Go ahead, from one of our members.
Hi, thank you for the presentation. It was very informative. I do have a question, but I was interested in something you just said. Why do you find that people don't want to talk, to tell people they have a policy?
The main reason that I have found, some people just kind of have a natural fear of, a natural fear of death. They don't even want to talk about it. I've even heard in interviews, some people, they may not be, too trustworthy. They don't want anyone to know that they're worth money. And that's that's a touchy subject. It's just risk, I love my family, but, if something happens, are they going to make a decision that increases my longevity or goes against my longevity because they know I'm worth a lot of money? Yeah. So it's just a touchy subject, and that's just the honest reason of why people don't talk about it.
Yeah, and I'll just add on to that exactly. I think the thing is that there's a difference between someone who has a $50,000 policy and you let them know, as opposed to someone who has a $2 million policy. And when you think about all the crazy movies you've seen, and people have actually killed people simply because of that reason. And, off the top of my head, I think that would probably be one of the top things, along with what Felicia said, people not wanting to burden people and share this information with people. But at the end of the day, the insurance company kind of has this information on file. So usually somebody knows what's going on. But to answer your question, that's usually the reasons why. Did we answer your question?
Yes, you did. That wasn't my actual question. It's just that she spoke about those things and it sparked a thought. And then also I was thinking, as she kind of touched on it in terms of, leaving policies to children. If your children are older, above the age of 18, are there ways where you can make sure that they receive maybe smaller payments? Because sometimes that is even an issue that, they're just not able to manage money, or even family members.
I'm not really sure if that may, with our policies that we do, we don't have any way we can specify like, wait until they're 18 or wait until they're 25. So we don't have that with our policies. I'm not sure how many companies do. what it usually is, it will be a lawyer who sets up the trust, and it will set it up that way. Like there is a, I think you would set up where you would pay the trust, and then the trust distributes the money in certain spurts of, $10,000 when they're 18, another $10,000 when they're 21. That is something that I don't think the insurance company would do themselves. It would usually be something like maybe a family trust or an estate, something like that, that can, hold the money back and determine how it's distributed.
Yeah, it's usually based on a percentage. So when Felicia was mentioning the primary and contingent beneficiaries, it's based on a certain percentage. So it needs to equal 100. So an example that you mentioned, a young person, let's just say they're 19 years old, they're not very good with money. You could just really say that they get 20%. They just get a smaller portion of the bigger pie. Or you can really just have a conversation with someone who you trust and just say that, I'm giving you the money and this is going to be for so-and-so because we both know how he or she is. They can't manage money, blah, 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 blah. So there's ways of working around it, but it's not that clear cut in a sense of a dollar amount saying $20,000.
So basically, if you don't want to go through like maybe, like a trust account or a law firm, something like that, you would basically just have to designate some older, I had this happen at my other job, some older grandparent or aunt who's responsible to divvy out the money, which could be risky in a sense. So it's all up to who you trust, but it's either a trustworthy family or taking some other legal option, because the insurance company usually doesn't, disperse it in that way of, giving it in increments. It all comes at once.
Did we answer your question?
Yes, you did. Thank you for that. And then I was in and out on the term versus whole life. So I was just wondering, I don't know if you can give from your, opinion as being in this field, which would be a better product? Because, with the term life, sometimes it expires after a certain period, and then the premiums just like skyrocket.
Mm-hmm. I found that usually the whole is just, let me back up a second. I find that people really use term for particular events. So like I said, I use the example with the house. Like if you have a mortgage, it's a 20-year mortgage and you want to use it for that. Or if someone has a business and they have other policies and maybe they have this term life policy that's going for a particular time. Maybe they have a loan on the business and that the term is covering that period of time. I found that between research, even part of our exam, and that people normally get terms to just kind of like offset a particular event. And then they have their whole life policy, which is just, you're just usually just, if you're 30 years old, you get it when you get it at a cheaper rate. You don't normally have as many health conditions. You don't really have to worry about the price going up. And then just like you said before, I know somebody that we're kind of working with, they have a $500,000 20-year term life policy. And the person's health condition is pretty bad at this particular time. So unless within the policy it gives you the ability to convert it to whole, most people just kind of just pay for that period of time and just that's it. It just serves that particular purpose.
So basically, I mean, if I would say it's kind of like might not be a given age, but I would say, if you're somewhere under 35 and you want to get in whole life while you can, because once you get older, it's going to be very, very hard to get if you get like a medical condition or anything. And whole life builds value that you can borrow against. I've seen people borrow against very old whole life policies for, maybe college expenses. So if you can get into a whole life while you're young, please try and do that. It's a really good option.
And you also have situations where people are young, maybe you can't afford to get a whole life policy. So if you're 20 years old and you decide to get, a 10-year policy, well, by the time you're 30, it's still reasonably priced. I mean, I know for myself, I think I got my policy when I was in my late 20s, early 30s. But I could have gotten it. I could have gotten term earlier, and then it could have been converted, and nothing was going on from a health standpoint or anything like that. And my policy, my whole life policy, really wouldn't have been astronomical because it's reasonable. Does that answer your question?
It does. Thank you.
You're welcome.
Just a note on life insurance in general, you just want to get it as soon as possible because if say if I'm unfortunately diagnosed with anything, once you get diagnosed with something, it's very hard to get into a life insurance policy. So you want to just kind of get it while you're either healthy or young, or even better yet, both.
Any other questions, Abdul?
I apologize. It's me again. This is my last one, but when she stated,
there's no limit. There's no limit.
When she stated about suicide, that because I just recently, with current events, a lot of stuff on Facebook recently.
Right.
I wasn't aware that life insurance even paid for suicide. So you said they actually pay it after 2 years?
It depends on the company. I don't have the policy in front of me, so I don't want to say too much, but some companies will pay for suicide if the person has had the policy for a long time. For some companies, it's 2 years. The reason why is they don't want people planning something and then doing it too much. It could have been premeditated, bought insurance policy, so all their kids will be covered and hurry up and do something. So yes, some companies do pay if the person commits suicide. It just you have to be in the policy for quite a while to be able to collect on that.
Mm-hmm.
That's interesting. Thank you.
Right. Mm-hmm.
I feel like you got one more.
There's no limit.
No, I don't. Thank you so much. It was great information.
We appreciate the questions.
All right, thank you for the great information. And so seeing no more questions in the room, I'd like to bring this presentation to a close. Thank you, Mark and Felicia, once again for presenting on this very, very, very much needed topic of insurance. And just want to remind everyone, if anyone wants to hear about more information about Central Jersey NSBE professionals, feel free to reach out to the president, which is myself, Abdul Kareem Dewan, at info@cjnsbe.org. All right, everyone, stay informed, stay safe, stay educated. All right, thank you, everyone, and have a good night. Thank you once again.
Thank you, Abdul, so much for having us. We appreciate it.
Absolutely. Thank you. Thank you.
Thanks.
Bye-bye.
All right, bye-bye.